Good afternoon, everyone. Thank you for joining us today. I'm Laura Labanier-Kitson, your CalTRUST CEO. And today we are doing one of our Demystifying series webinars, Demystifying the Fed. We thought this was a very timely webinar to go over the history and functionality of the FOMC, as I feel like in the last, I would say 2 to 3 years, we're talking about the Fed a lot more than we ever really have in the past. And it's really interesting as it's been coming up. There's a lot of insight often given on the history of the Fed and their functionality and their independence and so many things. So we thought this would be a great webinar to share with you today. I have Will Goldthwaite. He is our client portfolio manager of State Street Investment Management, joining us today to teach us about the Fed. State Street Investment Management, as most of you know, is our CalTRUST investment management team. So we work very closely with State Street. Please, we encourage you to be interactive. The chat should be properly enabled, so you can chat questions to us. Use the Q&A box is not here. Oh, there it is. Okay. Use the Q&A box and let this webinar be a tool for you. So without further ado, I am going to go ahead and pass it over to Will.
That's great. Thanks, Laura. Appreciate being here. So I do need to read my little disclaimer before we get started. So why don't I just go ahead and do that? I must let you know that the information on this webinar is intended for the confidential use of CalTRUST and State Street and their clients and prospects. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by me and Laura are our opinions and not that of our respective firms, CalTRUST and State Street. The comments do not constitute investment advice or analytical research and should not be relied upon as such. And we are recording this on Monday, March 16th at 1 p.m. Pacific time. Okay, so glad that's out of the way. Feel free to ask questions, as we roll through. I know someone already asked a question, which is fantastic. I love it. I'm going to try to tick off on things as we go. But of course, if you need clarification, questions answered. So this is what I'm going to try to do. I'm going to try to hit on the current tension with the Federal Reserve. Help you understand the complex history and creation of the Federal Reserve, how it has evolved, and how is it adopted it has adopted different processes and policies to help with the current conditions, and then where we are right now. So, current tension. I just thought these quotes were interesting because they really describe some of the challenges the Fed has had really prior to its inception. You can see that from Andrew Jackson, right? Such a concentration of power is dangerous. Speaking about centralized banking. Lyndon Johnson talking about William Martin, the then Fed chair, when Martin refused to lower interest rates to help Johnson finance the war in Vietnam. Richard Nixon quoted with regard to Arthur Burns, and I don't want to go out fast. I want money to be loose. I want the economy to boom. That sort of a quote sounds very familiar to what we're seeing today. So I think the level of criticism, verbal criticism, is not unprecedented as far as what we're experiencing today. I think what is unprecedented, or at least in my search of history, what I found to be unprecedented was the action of the DOJ. And as many of you know, a judge just I don't know what the exact legal term is, but turned down or threw out. They didn't throw it out. I know that's something they did. But Jeanine Pirro, who's the attorney general, who was working as the attorney for the Department of Justice, essentially that case against Powell and the Fed renovation has been thrown out with an overwhelming amount of evidence showing that this was politically motivated. So it's not done yet, but it certainly has had a big setback. So I will say criticism of the Fed is not unprecedented, but this level and involving the DOJ is unprecedented. And so it's something that just we want to keep an eye on, because if chair people, when they take that job, feel as though there's risk from a legal standpoint, then that just puts you know, creates noise in the back of one's head. So we'll keep a closer eye on that. Okay, so now let's just look at the timeline. So Federal Reserve Bank system established 1913. And then we're going to talk about really three distinct periods of time. And that is, well, really four, but that is through the 30s and 40s, 50s through the 70s, 80s to the global financial crisis, and then ultimately where we are today. So let's just talk about Woodrow Wilson was the sitting president when he signed the law that created the Fed. And he said a great industrial nation is controlled by a system of credit. Our system of credit is privately concentrated. I think this is very, very important to recognize, because in the panic of 1907, it was JP Morgan, literally the person, not the bank, but JP Morgan, the person that came in and provided the leadership and the liquidity to bail the country out of that crisis of 1907. And that really created the momentum that the country needed to create the Federal Reserve banking system. Now, what the country was very suspicious of, it was they were suspicious of banks having a concentration of power. So a single institution essentially controlling money supply, controlling interest rates. They were very suspicious of that. So what they did was they created a national banking system, and they created 12 reserve banks. The thing that was so that was so obvious was the inelasticity of the currency at that time and national banknotes. So back then, many banks would issue their own notes, and those notes were used as a form of currency. You can't even imagine that system today. But it was a system that was really all that was available. And remember, there wasn't any interstate banking laws back then. Like, banks were only eligible to bank in their state. And so we didn't have any national laws. There's a ton of bank runs, as I mentioned, the panic of 1907. So when the organization was created, it was created with these 12 reserve banks that are located all over the country, as far as San Francisco, as south as Dallas and Atlanta, as north as Cleveland, Boston, New York being the main operating bank. And so those banks in their respective regions were responsible for their lending operations. They were governed by their own reserve board. There were presidents of each one of those 12 institutions. And it was really those institutions that were responsible for ensuring that there was liquidity, there was oversight in the banking sector, and that things were operating as they thought they should be. But these are 12 distinct entities. Now, that became a problem during the crash of 1929 and the Great Depression. And why did it become a challenge? Because these banks were operating independently. These 12 banks were operating independently. They weren't acting as one. So through that period, they recognized that they needed a cohesive set of guidelines. They needed a cohesive set of principles in order to affect legislation. So one easy example here is that there were many institutions that were saying we needed to flood the market with liquidity. We needed to issue debt, and essentially flood the market with money, increase money supply during the 1930s. And there were some that were terrified of that. And the reason they were terrified of that is because the United States was a relatively new economy, And what central bankers were very worried about back then was your currency inflating. And in other words, the value of your currency declining and then not being able to trade, not having a stable currency. So they were worried if they flooded the market with currency, then it would kick off this great inflationary panic, and the currency would devalue and you'd have all sorts of challenges. So what they did was they constrained the money supply, and they were on the gold standard. They constrained the money supply, and then that led to more bank failures and further hardships for the American people. Well, the new legislation, the Banking Act of 33, the Banking Act of 1935, created rules. It centralized the leadership of the Fed in Washington, and ultimately it created the what we now know as the Federal Open Market Committee. And so this was a big deal because that meant that the Fed could now operate as one. So it sort of moved away from what the founding fathers intended, and that was decentralized, not one big institution control, but what they realized that this was actually a much better way to do things, is to have one central hub, of which then those 12 regional banks got their guidance, got their direction from that major hub. So that was a very important thing, the creation of the FOMC through the Banking Act of 1935. Now, when we move into the World War II period, this is when there's a new dynamic that evolves. So recall from 1930-ish to 1945, you had an incredible amount of government spending through that period. First, you had all the New Deal spending. FDR created a whole bunch of government spending that was meant to stimulate the U.S. economy, and essentially pull us out of the Great Depression. Additionally, we entered World War II. That required an enormous amount of spending by the U.S. government. So what you had there is you had fiscal dominance over monetary dominance. In other words, the Fed took cues from the Treasury, and the Treasury says, listen, we have to issue all this debt to pay for the war, so you need to keep interest rates low. And so the Fed said, fine, we'll do that. We'll keep interest rates low. In fact, they went so far as to buy all Treasury bills at 0.3%, so 3.75%, and buy all notes and bonds, U.S. Treasury notes and bonds, at 2.5%. So there was essentially a cap on interest rates. And that worked really well during that war period. There was rationing during that war period. So inflation was very much under control. There was price controls on many, many things. You're only allowed to buy a certain amount. You know, my mother's 95 years old. She was born in 1930. She lived through this period. She remembers going down to the butcher and only being able to buy, you know, a certain amount of beef to bring home and eat. And so it was a very constrained economy. Well, post 1945, the Fed was dealing with an entirely new dynamic. They had inflation levels that were reaching upwards of 10 and 20 and sometimes 30% inflationary levels. You had a post-war boom. And so the Treasury basically said, all right, you're telling us to cap interest rates, but we can't fight inflation because we can't raise interest rates in order to slow the economy down, and stop the inflation pressures that we're seeing out there. And so they reached what is called the Treasury-Fed Accord in 1951. And this is really described really well by saying it was not so much that the Treasury Fed Accord created that separation, because that separation was there, but what it did was it gave the Fed the confidence to tell the Treasury that they would no longer control interest rates, for the benefit of all of that debt issuance. And this was a huge challenge for Eisenhower. He had a Korean War that he was trying to finance, and he wanted interest rates low. And what you'll see throughout history is there's a very consistent pattern of presidents that want interest rates always lower than where they are because they want the economy to boom. But the Fed at that time had a mandate of price stability. They didn't have their dual mandate yet. And so through this period, inflation does remain a challenge, and there is still political influence throughout that organization. So it's not that straightforward as far as the Fed being able to manage inflation. And this is a period that runs all the way from the 1950s, all the way through the 60s, and all the way through the 70s. There's some great books out there on demographics. And I strongly encourage you to read those books on demographics because the other thing we had going on here was a massive baby boom, massive household formation, and massive growth in the economy because of all of those young people were coming of age and creating businesses and creating economic activity. And and also a big challenge for the Fed. So, that's a whole nother topic, but maybe we'll do another webinar on that, Laura, at some point. So when we get through the 70s, we still have a real challenge in the inflationary period, but we do enter this period of the great moderation. And so there's a couple things that are pretty important when we look at the Fed going through this cycle. First of all, the Federal Reserve Reform Act of 1977, that's where the Fed was told you have both an inflationary mandate, price stability, as well as full employment. And they wanted to make sure that Congress wanted to make sure that the Fed understood this in their mandate because there was this back and forth of when the when unemployment levels started to increase, the Fed panicked and they would lower rates, and that created an inflationary challenge. And so Congress wanted to make sure that, yes, we know that full employment is part of your mandate, and we want it to be part of your mandate, but price stability is also very important. So they wanted to just identify that as part of their mandate, this dual mandate, price stability and full employment. Additionally, the Humphrey Hawkins testimonies were formalized in 1978, and this is where the chairman of the Fed needs to present to Congress on a semi-annual basis and essentially needs to answer questions from lawmakers. Say, this is what we're doing. This is why we're doing it. If you've watched any of these, as I have over the years, you often realize it's a time when the lawmakers try to beat up on the chairperson. They try to ask them a lot of tough questions. Sometimes they know what they're talking about. Sometimes they don't know what they're talking about. But it is meant to give further transparency to the Fed. Now, what happened in 1979 is this gentleman named Paul Volcker showed up. And at this point, inflation was really entrenched in the economy, and there was high levels of inflation across the economy. And what Volcker recognized that this was more of a perception than a reality thing. So if someone perceives that the market, and this is really important to bring into context for 2021, 2022, even 2023 of right now, and it very much influences the Fed's thinking right now. So this is an important point to make here, and that is that Volcker recognized it was perception and not necessarily reality around inflation. So what did he do? He raised interest rates in a very wild and unpredictable way, raising the Fed funds rate as high as 20% at a couple different intervals during that period, essentially to shock the market out of this inflationary perception that it was in, and essentially to blast the economy. And like he certainly did, we had unemployment levels of upwards of 10% during some of those periods. We had the recession of 1980. We had the recession of 82, 83. We had major challenges within the economy. But what Volcker did do is he snuffed out inflation. He got inflation in control, and inflation started to trend lower from that point on. Now, there was a whole bunch of other things that played a part of that from a legislative standpoint. You think about deregulation, you think about the pro-capitalism, pro-real estate era that Ronald Reagan brought into that. So you can't just say it was Volcker, did it in and of itself. But I think the part that is most important here is that the Fed was really willing, Paul Volcker and the committee was really willing to do whatever it took to stop this very disruptive inflationary pressures that were in the economy. So that's pretty important to think about. Okay, yeah, and just remind folks if you do have any questions, don't hesitate to ask those in the chat or raise your hand, and we'll try to get to you. Okay, so the global financial crisis, we had sort of somewhat smooth sailing. We had various crises from the 80s and into the 90s, but the global financial crisis really culminated with the Fed doing things that weren't necessarily unprecedented, but it was a lot. And the Fed worked very closely with the Treasury. Recall Treasury Secretary Hank Paulson at the time and Ben Bernanke was the chairman of the Fed, and they did all sorts of things. One of the things they did was bring interest rates to zero. They stabilized markets by flooding the market with liquidity using quantitative easing. They also were able to use the Economic Stability Fund to essentially be given capital by the Treasury so they could go out and buy other asset classes. This is also very important because that also gets put to use during the COVID crisis. And so the Fed really did go to extremes to make the global financial crisis just a crisis and not a depression. And I feel very strongly about that, that had it not been for all of those tools that the Fed used and that the Treasury used to try to stabilize that market, we would have seen a decade very similar to what we saw in the 1930s. So that was a very important point for the Fed during that period. And so then that brings us to this zero interest rate and beyond. Where are we right now with the Fed? So 2008, they cut interest rates to zero. They came out with a very aggressive quantitative easing policy, and they really started reworking the monetary policy transition mechanism. And so what does that mean? Prior to 2008, the Fed did not pay interest on reserves. And what they did was they operated in a scarce reserve regime. And so they would go into the market, open market, and they would do repos in order to create liquidity or drain liquidity from the market. And then ultimately that would push the Fed funds rate higher or lower, depending on, what sort of activity they were doing in the market. Well, what the Fed had talked about for a while is setting an interest rate and paying an interest rate on reserves. And so that went into effect in 2008, and the Fed began to pay interest on excess reserves. Right now, that's at 3.75. And so banks can drop reserves into the Fed and get paid interest on that. And that was a very different way of doing it. I mean, once Kevin Warsh comes into office, it will be interesting to see if the Fed continues with this, because it is talked about that he does want to continue to shrink the size of the Fed's balance sheet. And the way it's constructed right now, it would be hard to do that. So it will be interesting to see how he takes hold and what he decides should be the path forward. Okay, so we're getting close on time. I know this is scheduled to be a 30-minute webinar. So I wanted to just talk about a couple other things, Laura, really one other thing. And then I wanted to also open it up for questions if there were questions. So the thing that I want to talk about now is the summary of economic projections. So this is something in the current Fed, we know transparent framework, risk aware, independence is earned and not granted. Independence is earned. So if the Fed is doing a good job, then the lawmakers tend to leave them alone. If there's, criticism around the Fed, that's when the lawmakers start to sort of step in and wonder, what they're doing. Are they doing a good job? And then market maker of last resort. And certainly what we talked about during the COVID epidemic, and then ultimately during the global financial crisis is testimony to the fact that they were certainly market maker of last resorts. Um, but I want to talk a little bit about the statement of economic projections because this is something that folks often see as a forecast. They say, oh, well, the Fed thinks inflation is going to be here, and therefore that's where inflation is going to be. And I just want to clarify that it's what that particular member of the FOMC committee feels as though in their forecast, that's where they have it going at that point in time. So that is their forecast, but it's the combination of all of those members. And there's 19 total members. There's 12 voting members, but there's a total of 19 total members that submit to that. And so the unemployment rate, the inflation rate, and the GDP growth are forecasts from each one of those. So it's a blend, and it's what they felt as though it was their opinion at that time. And then ultimately they're asked to say, well, if all of your forecast says this, then where do you think Fed funds policy rate is going to be? And this is what we refer to as the dot plot. Um, and that is an opinion at a point in time. And it's not supposed to be like, hey, this is where I think Fed funds is going to be. It's like, if you ask me to predict where it is right now today, then that's where I think it will be. So I know I'm kind of splitting hairs here a little bit, but I do think it's important to recognize that from that standpoint, they're not trying to say, this is our forecast. This is where we think rates are going to be, as much as they're trying to say, this is what my opinion was at this point in time. Okay, so I'm going to leave it here. From a summary standpoint, I just want to sort of highlight a couple things that we talked about. First of all, Fed created through a crisis. So the 1907 economic crisis, led to the creation. There had been a lot of resistance on a central bank for maybe 100 years. It was really interesting when you go back and read some of the historical accounts of people wanting to create a central bank and then people saying no, 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 no. And I think it very much comes from our libertarian roots as a country. There's this idea of not wanting to have a centralized bank. But so the bank was built to be constrained. It was designed to be constrained. It expanded through necessity. It's constantly debated. We know that. But it is central to markets. It is absolutely probably the most important bank in the world because essentially, given the size of the US economy and how our markets affect so many others, it's very, very important for us to keep a close eye on that institution. Laura, I'll pause there. I know we're sort of right up on time, but do you have any questions?
Yeah, there's a few more things I wanted to touch on, Will, if you have a couple moments. And for
Yeah,
folks
of
who need
course.
to pop off because we are at time, we will have a recording of this available so they can kind of catch up on the end if they need to go. But there's a couple of items I wanted to go back to and get some more clarification on for everyone. So I thought this was a really interesting point. You talked about that during the extremes during the global financial crisis kept it a crisis versus a depression. Can you discuss a little bit about what, technically a depression is and kind of that difference between it being a crisis versus becoming a depression?
Yeah. I know that there's probably a technical definition. It's probably something like GDP is down, a large percentage, or maybe down 4 quarters in a row or something that is the definition. But I think the point of me raising that is just looking at how much liquidity that the Fed injected into the economy during that period was critical to prevent a much worse outcome, right? I mean, you look at the intermediation they played in the rescue of AIG. You look at the intermediation they played in the rescue of Fannie Mae, Freddie Mac. I think if you could rewind the tape and they could go back and do it over again, they might have done something different with Lehman. That's just me speculating. But then ultimately the forced marriages with Bear Stearns and JP Morgan, with Merrill Lynch and B of A. you know, they were central to that. And that's not dissimilar from what JP Morgan did back in 1907 to solve that crisis. I mean, he was instrumental in the merging of certain companies that were essentially going out of business and the sourcing of capital to provide the liquidity. And it's worthwhile to mention that the Economic Stabilization Fund, the ESF, is something that the U.S. Treasury Secretary is allowed to grant with permission of the president to the Federal Reserve that provides capital to the Federal Reserve. Because recall, the Federal Reserve is only allowed to buy U.S. Treasuries or government agency debt. So that capital then allows the Federal Reserve to go out and buy things like high yield ETFs, which they did during COVID, and essentially support that market and create liquidity in that market. And we all probably remember in this call during March 2020, the market was under extreme stress, and then the Fed came in and just said they were going to start buying these assets, and there was a huge bid to the market. So sometimes that's another thing where perception, we talked about Volcker's idea around inflation, getting inflation under control was changing the perception. So sometimes just the perception was good enough. For example, you remember Ben Bernanke, he wasn't a Mario Draghi quote, but he basically said to Hank Paulson, we need unlimited funds to save the banking system in 2008. He said that, and all the Congress was freaking out. What do you mean unlimited? What does that mean? He says, we're not going to take unlimited money. We just need to say that to give confidence to the banking system. So sometimes it's words are way more important than actions when it comes to the Fed.
Another thing I think that is really important to, especially in this day and age, talk about is, can you talk a little bit more about how the Fed maintains their structure of independence and the terms and the staggering of the terms so that they are kind of as politically independent as they can be, and who makes up the 19 members and how it's structured?
Yeah, absolutely. So the FOMC, which was formed in 1930, or which was formalized in 1935, is a group of 7 members that sit in Washington. They are nominated by the president. These 7 members are nominated by the president and then confirmed by the Senate, and they serve 14-year terms. And the reason they're 14-year terms is because they want those terms to be outside political influence. So they want those terms to be long enough so that whoever nominated them and confirmed them might not necessarily be around for their entire tenure. And I think that's really important for those 7 members of the FOMC. The 8th member of the FOMC is the New York Fed president, so the president of the New York Fed. And the reason that's a permanent seat, is because that's where all of the money operations take place. That's where all of the repo trades do. That's where they do QE, QT. That's where all of the market operations take place. So they have a permanent seat. So that's the 8th person. And then the remaining 4 are rotating on a 1-year basis from from the 11 other reserve banks. So they'll rotate through from Boston, Richmond, Cleveland, Atlanta, Dallas, San Francisco, Minnesota, Minneapolis, Kansas City, St. Louis. They will rotate all through there, and they'll serve 1-year terms. Okay. So you have 7 people that are on 14-year terms. You have one permanent seat in New York, and then you've got 4 that are rotating through on 1-year terms. So just by that design, that really doesn't leave any room for political influence. Like if if I'm the president and I, appoint someone to be on the FOMC, that person might think, oh, I'm the best president ever. I'm going to do what you want, but I'm only one vote. And that one vote is against 11 other votes, right? So even if you have 2 or even 3 people that are in the president's back pocket, you still have a whole bunch of others that may or may not be. And then you have these 4 other seats that are rotating on a 1-year basis. So it's not to say that the Fed hasn't been politically influenced over time. I guess Arthur Burns is the most notable of, doing favor for Nixon and ultimately causing the massive inflationary pressures that we saw during the 1970s. But the structure of the FOMC is supposed to prevent that.
So I believe it's mid-May we should see Warsh taking his seat, correct, as the new chair of the Federal Reserve.
That is correct.
What are we looking out for between now and then, or is there anything monumental coming in the time frame to give us kind of a hint of how he might be in that role?
Yeah, that's a great question. So we've been in a blackout period since this war started. So the Fed goes into a 2-week blackout period before every meeting, and so they have a meeting this Wednesday, and so we haven't heard from any officials. And so once we get past this meeting, we will then see Fed presidents and FOMC members. They'll go back out on the road. They'll start being interviewed. They'll start speak at local events, conferences, et cetera. And we're going to start to hear from those members. What do they think? The war, inflation, energy shock, what's happening? And so we're going to start to get a lot of information as far as how they're feeling and also what they're hearing from their own districts, right? One thing I do want to mention that I think is really important is those Federal Reserve banks that are located, the 12 of them that are located all over the country, they do an incredible job of reaching out to the community to find out what's going on in the community. So they have a lot of people that are boots on the ground that go out and they speak to business owners and they say, how's business? What's going on? They have town hall meetings. They have a Fed Listens program. So they spend a lot of time listening to what's going on out in the community. And so that's very, very important. So I think that's the first thing we're going to hear a lot. Now, as far as Warsh goes, some people will say, oh, well, he's a balance sheet hawk. In other words, he wants to see a smaller balance sheet. But those are probably a little bit dated views, right? Because that's at a time when he was on the committee, and that was back in late 2000s and early 2010s. It's very possible that his opinions have changed dramatically. We know that he was very interested in getting the job. He was a finalist when President Trump nominated Chairman Powell. He was a finalist in that running, so we knew that he's very eager to get the job. So I'm sure he, had smooth and lovely words to share with the president in order to put himself in the best position to get that job. But ultimately, his role as chairman is much more of a mediator. He's much more of one that has to pull this committee together and come out with a cohesive message. And if you've ever talked to a team of economists, you know that they're a very opinionated group. They believe their models is the right models. They believe their view is the right view. And so that's going to be a full-time job, literally, to try to get that group onto the same page. On top of that, we've got an incredibly complex environment right now that is pushing and pulling on a lot of different things. There's a lot of people on the committee that didn't think we should lower rates in December. And there's some people that thought we should be lowering rates more in December. So there's a lot of debate that goes back and forth in this committee. And I think Kevin Warsh is going to have his hands full trying to bring that committee together and try to come up with cohesive views that he can share with the market.
Oh, great. Well, thank you, Will. I know we have gone a little bit over. I appreciate everyone's time joining us today. Unless you have any final comments, I'll go ahead and wrap us up. All right.
Thank you, Laura.
Again, everyone, thank you for joining us for part of your Monday afternoon. I did just want to point out that our next webinar will be Monday, March 23rd, so a week from today at 11 a.m., and that will be our post-Fed meeting discussion. So as we mentioned, the Fed meets this week, so we'll meet on Monday to have a market update, talk about what action they took or didn't take, and kind of what came out of that meeting. So please join us for that. If you registered for this webinar, you should have seen the registration for that one as well. They came out together, but we will be having that sent out again soon. This will be available on our website soon, so we'll send out an email when the recording is ready to go. Also, I just want to say, if there are any other topics you would like us to include in our Demystifying series, please feel free to shoot me an email, Laura, Laura, @caltrust.org, and give us your ideas. We really want to be bringing education and information forward that's helpful to you. So, Will, thank you so much for your time. It's a pleasure as always, and I hope everyone has a wonderful day.
Thanks, Laura. Thank you, everybody. Bye-bye.